Welcome back, dividend investors. Today's video is on a stock that has a 7% dividend growth over the last 5 years. As a matter of fact, the last growth was 12%, and it seems to be undervalued. So if you want to learn more about Whirlpool, then stay tuned. Hey guys, Kevin Burgess back with yet another video. Today we're going to talk about Whirlpool. Whirlpool is now the fourth largest holding in my portfolio. So I thought it would be good to take a deep dive into Whirlpool and see if it's a stock that I want to continue with or even add to or do away with. So when we do a financial analysis on a company, we don't just look at their financial numbers. We look at their industry, we look at their competition, we look at their risks, we look at their competitive advantages, we look at their capital allocation policy, et cetera, et cetera. So we're going to look at a lot of things. We want to look at the holistic part of the business, and we also want to understand how they may perform in the future, not just how their numbers have been in the past. So if you're interested in looking at Whirlpool in that way, let's get started. Whirlpool manufactures and markets home appliances and related products. The company's principal products include refrigerators, freezers, ice makers, and refrigerator water filters, laundry appliances and related laundry accessories, cooking and other small domestic appliances, and dishwasher appliances and related accessories, as well as mixers. I mean, who hasn't seen a Whirlpool appliance in their life? This company is nearly ubiquitous. It markets and distributes its products primarily under the Whirlpool, Maytag, KitchenAid, Genair, Amana, and then a bunch of other brands that I've not heard of. I have heard of Hotpoint and Speed Queen, but those are from the old days, I think. And the rest of these brands I've not heard of, but there's a lot of them. The company sells its products to retailers, distributors, dealers, builders, and other manufacturers, as well as directly to consumers. Whirlpool was founded in 1911 and is headquartered in Benton Harbor, Michigan. It's in the household appliances industry, which is in the consumer discretionary sector. They are the largest in their particular area by far, at least 2 times the size of their next competitor. In terms of segments, they have 4. One is in North America, and they're all geographic. So they have a North American segment, an EMEA segment, which is Europe, Middle East, and Africa. And then they have a Latin American segment as well as an Asian segment. You can tell that North America is the largest, 57%. Europe is second. Europe, Middle East, Africa is second with 23%. Latin America is third at 14%. And Asia is last at 6%. And all of those are based on the percentage of sales. Competitive advantages. There's 2 that I see. One is that they have some powerful brand names. So Whirlpool, Maytag, KitchenAid, Genair, Amana. I mean, we've all heard of those brands. As a matter of fact, when you look at a house to purchase, one of the questions that gets asked is, what kind of appliances do they have? And if they have Whirlpool or Maytag, then those are pretty good. If they have, Hotpoint and, some of the other lesser known brands, then they're not as good. And so it actually becomes a decision point for homeowners in what appliances to put in if they're planning to sell their home in the near future or whatever. The second competitive advantage they have is because they are so big in this arena, they have tremendous economies of scale. They can produce appliances with similar makeups, with similar parts, with similar screws and paint, yet have different brand names on them. And because of that, they can have these economies of scale where they can buy large amounts of supplies and components that drives down the cost of these appliances. In terms of risks, there are risks in every company. This one has huge risk in competition. There's operational risks related to supply chain. There's cyclicality in this particular investment. They are heavily dependent on the economy and real estate. If the economy is booming, then Whirlpool's going to be booming. If the real estate market is booming, Whirlpool will be booming, and vice versa. They have international risk as well. They have political risk because they are in so many countries. There's a lot of political risk related to their business, and also exchange risk. The foreign currency exchange is a risk for them. And then, as every company has, litigation and regulation are also risks for them. Capital allocation, they have the last 10 years of dividend growth, which is really, really good. And they have uninterrupted dividends for 30 years. So that's a pretty good streak of time. You can see that their last 5 years compounds at a 7% average. Their last one, which was in April 21, is at 12%. And over 20 years also, they are at a 7% average. Their current dividend yield is 2.58%, which is almost double the market. In terms of shares outstanding, on this chart, they've gone from 78 million in 2011 down to 63 million in 2021. I think that might be a little misleading. On the right-hand side of the screen, in the latest 10Q, the company disclosed the following. During the 9 months ended September 30th, 2021, we repurchased approximately 3 million shares under these share repurchase programs at an aggregate price of approximately $641 million. That's about 5% of their outstanding shares that they repurchased in 2021. So I think when the K comes out here soon, I think we're going to actually see that their shares outstanding are probably more like 61 million, maybe even as low as 60 million. They have share buyback program in place that has $1.9 billion remaining at the end of Q3 2021. Will be interesting to see if they utilized any of that in the fourth quarter. The sales for Whirlpool are up and to the right, which is the way we like to see them. In terms of earnings per share, that is also up and to the right. Free cash flow is up and to the right. These are really stellar graphs, and they are consistently going in the right direction. Earnings payout ratio is very, very healthy. I mean, you look at the last 12 months being at a 20% payout ratio, and the next 12 months being at a 23% payout ratio. That's pretty healthy. I have no issues with that whatsoever. Even on the free cash flow side, I've circled the last 12 months, which is a 17% payout ratio related to cash. And so that's very, very healthy. They have a 70 dividend rating, according to Simply Safe Dividends, and they have a BBB credit rating. Net debt to capital, they are making a lot of headway there. You can see in 2018, they were at a 69% debt to total capital. Now they are at a 42% debt to total capital. Huge progress, and that's good to see. And similarly, we see the interest coverage going way up to 14.48, which is very, very healthy. They have no issues covering their debt load. Let's talk about valuation for a minute. Typically, I use Morningstar as my source of valuation. I will say that I really like Morningstar's in-depth valuation of a company. They go way into detail. I can really get a sense for what's going on with that company. However, in the case of Whirlpool, you'll notice that there is a Q beside the valuation. And what that means is they don't have anyone assigned to analyze Whirlpool. So what they do is they use an algorithm and they look at various stocks and they come up with a mathematical equation around what they believe the fair value is for the stock. I first pulled the valuation from Morningstar on January 11th. You see that one on the left. The closing price was $227.30 with a fair value of $224.94. But then 3 days later, the stock went down $10 a share, which is, about 5%. And the fair value moved along with it. And I think we all recognize that fair value is not based on the stock market price. Fair value is based on the worth and the value of the business. And then at the bottom, you see on the left-hand side, they gave it a narrow moat. On the right-hand side, they gave it no moat. I believe it does have a moat in its brands and in its economies of scale. And I think it's narrow. I don't think it's a wide moat, but I think it is narrow. So I'm not comfortable with this Morningstar analysis on Whirlpool. And I want to be careful there. It's not that I don't believe in Morningstar, but when they have a Q out beside these stocks, we should discount that. And it's just basically an algorithm that they go through. So we have to come at it from a different perspective. So I pulled up fast graphs. And as you can see in fast graphs, the price of the stock, which is the black line, and this is in the max range here, so you can see the whole history that's in fast graphs. It's currently trading at below its normal PE ratio. So it, according to fast graphs, is heavily undervalued. And another piece to this puzzle is look at this return on invested capital. I mean, it has gone from the mid-teens to the last 12 months being in the 23% range. That's phenomenal. And if you think about cost of capital, maybe a weighted average cost of capital being like 7 or 8%, that's a significant amount of value that's being provided every year by this management team. According to Seeking Alpha, the average target price is $239. So let's say a year from now, they expect it to be $239. So the current price is $217. I did my own DCF, discounted cash flow calculation for Whirlpool and came out with a $248 price, which tells me it's at a 12% discount. That is my calculation. So I want to be on record saying that. And it was very conservative. It is important to point out, though, that Whirlpool historically trades below its fair value. So because it's 248 doesn't mean that it's going to be 248. It just means that from a discounted cash flow perspective, at least based on the assumptions that I've used in my model, it's $248. The return on capital is consistently in the mid-teens. The latest is 23%. We saw that on the previous chart. The current PE ratio is 8.25 compared to the 5-year historical PE of about 10, somewhere in the 10 range. So in summary, Whirlpool has iconic appliance brand names. It has a healthy payout ratio, strong cash flows, consistent and strong return on invested capital. It has a 7% dividend growth CAGR over the last 5 years, and the most recent was a 12% increase. On the flip side, they're in an extremely competitive industry. They're heavily dependent on the strength of the economy and the real estate market, and their results can be cyclical because of that. So based on all of that, what have I decided to do? I've decided to add incrementally to my investment of Whirlpool when the stock dips below my average cost, which is 216.87. So somewhere around the 217 range. We saw in a previous slide that the price currently is at 217.02. So if it dips from here, I'm probably a buyer in this market. So let's move on then to look at one other thing. We'll look at Seeking Alpha. Here's what so they have a bull say and a bear say. So if a analyst in Seeking Alpha is a bull, meaning that they are favorable toward the stock, they would have articles in the bull say category. If an author has an article about Whirlpool and they're not so favorable about Whirlpool, it goes in the bear say column. There are no current bear say articles. So on the bull say side, you have the first one says rising home demand, disposable income, and cyclical appliance replacement demand means that demand for the company's products has increased. The second one, Whirlpool's Q3 was pretty soft, but the balance sheet remains robust, and the excellent free cash flow result underpins aggressive share repurchases which further enhance the value and performance per share. The last one says, based on current valuation and future estimates, I see an upside of no less than 9 to 19% annually for this company here. It's a buy. So 9 to 19%, I'm saying it's at a 12% discount. That's probably, a pretty reasonable range. So I'm very comfortable with Whirlpool being in my portfolio. I think it's going to be a good stock. I do believe that we have to understand its cyclical nature. It is going to go up and it's going to come down, and it's probably going to do those pretty quickly at any given point in time. But I think it's worthwhile. So if you like this analysis, if you wouldn't mind giving a thumbs up to the video, that would help the channel and I would appreciate it immensely. And also, if you like this type of video, if you're a dividend investor or want to be a dividend investor, consider subscribing to the channel. As you know, I'm not an investing professional. I'm just basically taking you on this journey with me as I walk through my portfolio, doing a deep dive analysis in each stock based on the order that it holds in my portfolio. The goal of this channel is to inspire investors to personal freedom, meaning that you can retire whenever you want. And we're going to do that one investment at a time. It takes a while to get there, but I want to inspire you to get there. That's very important to me. So if you have any questions on Whirlpool, or if you have a different opinion on Whirlpool, I'd love to hear them in the comments below. Feel free to message me there and I will respond to you. So I hope you liked this analysis on Whirlpool. The next one on the list is Johnson & Johnson. That should be pretty interesting as they're about to go through a split of some sort. And we're going to dive deeply into that and look at Johnson & Johnson and see where it should hold a place in our portfolio. With that being said, I will see you on the next video.